Now there's only 100 character space limit in the YouTube titles, so I can't give you the full explanation in the title, but there are definitely banks that I would not touch, and there are maybe a couple that I would look to consider buying somewhere down the track. So that's what I want to talk about in today's video, is the banks on the Australian stock market, and blend into that why, and then look at the property cycle as well in regards to this. If you're new to the channel, thank you for stopping by. My name is Jason Pizzino, and you can consider hitting the subscribe button if you want to see more on Australian finances, cryptocurrencies, and the property market. Over here, we encapsulate everything together so you can get a better idea of what it is you are investing in and potentially trading in, because we want to build our portfolios to live a financially free lifestyle. So like I said earlier in the intro, today's video is on Australian banks, and we want to blend this together with the news that we hear about the property market and why these two things are important. But just before I do, just wanted to mention this is not financial advice. However, if you consider it financial advice, I'd love to see your comments down below why you think it's financial advice. And at the same time, hit the like button down below. Also helps me out on the YouTube algorithm. Let's see if we can get this video to 300 likes. You guys have been fantastic in the past, so why not continue it into the future? So I did mention that we are here to build a community of active and like-minded investors and traders in all things finance, in order to be able to build our portfolios up to a point where we are financially free and we have our time back to ourselves. This is super important to me because I think that's the way that we progress humanity, society. While we're stuck in our jobs, not being able to be inspired, go out there and do the things that we love, I think that's what holds us back. So that is my main purpose for this, and why I really encourage people to jump on board and really start to look at their wealth, and of course other areas of life, but in particular on this channel, the wealth. I'll mention the structure of today's video, and we're going to look at the macro view of these charts, get down to a micro view, so basically going from big picture to small picture, market sentiment, other news and fundamentals that surround these, and then my opinion, of course, because it's not financial advice, of these bank stocks. So with that said, let's jump across to the charts and go and nerd it out over there. On my channel, a video that I did many months ago titled How Market Cycles Work, Easily and Complete Explanation. This is the video right here, and doesn't have many views, doesn't have many likes. I've liked my own video to get the algorithm up, of course. I need your help here. Come on, guys. Basically, this video talks about the property cycle and where we are currently sitting. That's important because of news like this. So if banks can lend more, then potentially they're going to make more profits, which means their stock price should increase. And where do they lend most of the money to? Business and property. So this is relating into that, because this is how property cycles work in the 18.6 year cycle, which has had so much research done on it over the last 200 plus years. I've got a book somewhere right here where my microphone is. This thing, amazing. You want to know about how to understand the real estate and banking. This thick book from Phil Anderson explains the works. You don't need to listen to talking heads like me and anyone else online. That whole book will explain it all. I'll get to that in future videos. It's awesome. Where we're at is this video, property cycles, banking. We understand banking stocks. This is how I relate it all in terms of my own fundamental information. This is the 18-year property cycle. We are currently sitting at the mid-cycle slowdown. You will probably be seen and told that we should be in this massive, deep recession, depression period. A long way from that, in my opinion. I definitely do not see that in the markets. I don't see it in the news. This is not happening yet. This is not GFC style 2008 depressions. We're only in this mid-cycle slowdown, and we are going to get a very big boom coming up in the coming years. This is rough. Not 774, but essentially this is where we're sitting, somewhere in this mid-cycle. Next year could probably be rough as well, to 2021. After that, we're going on a long and cruisy run to the top, and people are going to get caught out really badly, missing this opportunity now and getting in way too late. It's exactly the same as our pump and dump stocks, except on a much bigger time frame. The same mental and emotional games happen in all of these markets. It just depends on how quickly they play out. Now, our first bank we're going to have a look at is Macquarie Group. Now, I'm putting this one first because it's actually a bank that I like the look of. It has been increasing for many years. Market cap is pretty high, 42 billion. Dividend yield of 4%. And if we have a look at its chart from a macro view, because that's what we're going to do first, we see that it's just been on a tear ever since 2011. So somewhere around that 2011 mark, it was sitting at about $20 or $22, $25. And currently we see ourselves at 120. I like this bounce. I think it's got a sustained move coming from it, especially as I see this low here. So you can see that around 120. There was a previous low put in here. It's also been support here. It's broken the support, but then also come back above it. Broke it and it's come back above. So I think 120 is a reasonable level if you were too afraid to buy it 70 or $80 on that massive dip in March. How could we have seen 70 to be a low? That's a pretty tough game. I won't say that I could have called it, but there are some support and resistance levels back from 2015 through 2017 that you can see some levels of support and resistance coming up. So one of those in particular, I would say, is around 85. Now, these things always have the potential to just burst through and then bounce back. It's just like bouncing a ball, like it's not going to directly hit on that exact spot and just stay there. It's going to bounce. And so that's where the energy of that market stopped, found its little support around 85-ish, 80 to 85, as you can see from these closing prices of the months, and then it's taken off from there. Macquarie Group I like because it is on this trend of up and up and up. Not to say that it can't fall out of the sky, because that's a decent over 50% drop, but it's been on a tear all the way up as the other banks, the big four, haven't made gains. Macquarie Group has continued to make gains. So that's the first important point that I look at with the banks. Now I'm going to skip through the next four, work through them. Commonwealth Bank, 115 billion, 4%. Look at CommBank. All right, these little ads that you see on the side, this is the free version, which you guys can get. This is for tradingview.com if you're asking about the charts. Link is in the description. You get the paid version, gets rid of all the ads, and it has extra tools. Pretty cool thing, pretty cool feature, but you can do everything we're doing with the free version. Just thought I'd mention that because some people ask. Back to the Commonwealth Bank chart. Commonwealth Bank looks similar to Macquarie Group. It's been going up since its inception into the ASX, 1991. And it pays a reasonable dividend, like we could see there, 4%. So if you're buying it now at $64, look, maybe it doubles. I'm just using it for round numbers. Maybe it doesn't. But 64 to 130, you're then getting basically a 9% yield if they continue to pay the same yield on your original investment. I like this area as a good buy place for Commonwealth Bank. So this is the macro view, and then my opinion as well of these stocks. You've got old highs from the GFC, another old high just after the GFC when property was at its lowest in Australia, was around 2011 was its low for property, and the banking sector continued to move, or at least CBA did. So keep that in mind. CBA was a mover. That's why I would consider these two as something for my portfolio if I liked banks, if I considered the property market to continue going up, because I think they're a decent, they work well with property because you need the banks for property. And if property is going to go up, banks are going to go up, banks are going to go up, property should also go up. That's my views for these two, Macquarie and CBA. Now let's move across to the other three in the top four, and I don't like these anywhere near as much. Westpac also pays a good yield, 4%, market cap of 60 billion. Westpac, let's have a look at the full chart, and it's all the way down at its GFC low price. Why? Why is a bank this low? I don't understand. You guys let me know what your thoughts are. Are they losing market share to CBA, to Macquarie Group? Are they not doing as much lending as the other banks? Are their products just not as good? This is a bad sign for a bank. I would not be buying this purely for a yield. For you to lose 4%, all this thing has to do is go from $20. Now let's do some quick maths. Has to drop less than $1? So 20 to 19, you've lost your 4%. I'm not sure that this is worth it. Obviously, that's the same deal for CBA and Macquarie Group. They just have to fall a little bit to lose your 4% of your dividend yield. But the chart, the pattern in Westpac and the other two, which you'll see, are just not convincing overall when you compare them to the other banks like Macquarie and CBA. This is at a double bottom. That should be a good sign, and we should see a pump from here if the double bottom is strong. And I think it could be strong because This low has very high volume on a monthly bar. Like I said, these things can definitely go up, but I'm trying to pick out of the top 5 here. I'm just trying to pick 1 or 2 because I'm not going to put all of my money into all of them. And this is how I do it. Let's move across to ANZ. Same, 50 billion, huge dividend yields. What's going on here? Why are they offering 7% dividend yields? ANZ, similar chart, slightly higher low than the GFC low. It was on a downward spiral from 2015. So something wasn't going too well for this bank in particular. And overall, it's just not that interesting. If you bought this stock in 2002, you've made no money. You have made no money in nearly 20 years, unless you sold it at the top, bought it at the bottom, sold it at the top, bought it at the bottom. So you need to trade these other markets. This is why I don't like them as long-term investments for the average investor. They're blue chip stuff. They've been around forever. Everyone knows the name. They know what they do, and they're just easy to buy into. But in terms of an investment, if I'm putting my money in here, I want it to do something for me. And ANZ has done nothing for me if I held it long-term from 2002. If I held it long-term from 2007, I would be destroyed. If I held it long-term from, you get the point. Hold it anywhere from here, you are out of pocket. You buy it at this GFC low, which is the most difficult time to buy a stock when, markets are going down. Then sure, you're up a little bit. But you and I both know these are probably not the most exciting stocks to be in, especially seeing this chart. Now that leads me to the last one, which is NAB. They've also got a high dividend yield of 6%, 60 billion market cap. Their chart is just as sad as Westpac. ANZ's just the slightly stronger out of those 3. See, they're higher low compared to the GFC, and Westpac, again, it's a bit lower. But NAB looks like the weakest. Oh, wow. Yep, NAB is the weakest out of the 3 of these stocks out of the big 4. NAB would be the last one I would touch. So there's my macro view. Micro, I don't think we need to look at this point. Market sentiment, it goes to Macquarie Group. They're always doing something to increase their profits, the way they are working, what the other services they're offering. NAB could not even break its GFC high, its pre-GFC 2007 high, which means people aren't seeing that it is actually making profits better than what it was prior to the global financial crisis. And now its low is its low is lower than the GFC. This one is off my list. NAB, gone straight away. I don't care if they're paying me 6%. I just don't see this thing doing too well. Even if it was to double, I think there's much better opportunities out there. So NAB's off. ANZ, the best out of those 3. Westpac, another boring stock. CBA, not bad. If you didn't want to get into Macquarie Group and you wanted one out of these 5 and you wanted a bank in your portfolio, CBA, I think it's okay. And then Macquarie Group is my pick out of the bunch because I think it still has more room to grow compared to the others. That'll wrap us up there for the banks, guys. If you want to know any more about banks, let me know in the comments down below. Any other banks you want to look at, what your position is on including banks into your portfolio and why. Why would you want to do that when there are other opportunities out there that can potentially scale more, give you better returns? Why would banking be something that you'd be interested in? I'll leave that one there. If you found value from it, let me know in the comments down below, specifically what you learned from the video. And of course, like up the video and consider subscribing as well if you haven't done so already. Link to the Discord that I showed you earlier on is in the description, so be sure to click that now, go across there. I've also got the crypto.com debit card link in the description where you can get 12% interest on your AUD or USD in crypto form. This thing's great. I wouldn't bet the house on it, but I think it's pretty cool to be able to get a really high interest rate return. That's due to their marketing and it won't last forever. That's it for this video, guys. I've got heaps more coming up for you next week based on the poll that I put out last week. I've got the one in there in regards to how I went from purchasing property at 20 to property developing at 27. So stick around for that. That's a really interesting one, and we can get further into the property cycle and where I see that going from here. Your support on the channel has been amazing, guys. Thank you so much. I can't thank you enough, apart from putting out as much content as I can and giving you as much value. So I'll leave it there and I'll see you guys at the next one. Until then, have more fun to get more done.